each of us, I think, has a limited quota of 100 baggers that will show up in our portfolio. Uh, I think I have had more than my quota of 100 baggers that I was smart enough to buy, but too dumb to hold. And there's a long list. I used to own Kotak Mahindra Bank in 94. I don't know, it's 150 times. I probably got like 30% return after 5 years, sold it. Um, Blue Dart. There's 200 baggers I did capture. I owned Amazon in 2002, I think, at $10 a share. And I think it was 10% of my portfolio then. And I got 40% in a few months and I was out. So it was great. But anyway, so what I have learned is that don't don't sell the compounders when they get fully priced, and don't sell the compounders when they get overpriced. Uh, Only sell the compounders it is when it's absolutely obvious to you that it's egregiously priced. The big money is in riding the compounders, and but you have to try to get in on them at a reasonable valuation, and that you have to be right on the fact that they are compounders. And so, it's a forgiving business. You can be wrong quite a few times and still be okay.
So, Mohnish, does that by corollary mean that your buy versus hold criteria may not be identical?
It is not identical. That's correct. I mean, this is a very difficult lesson for a cheapskate like me. It was a very difficult lesson for Warren and Charlie. I think they learned that lesson from Seas Candy. That was a seminal purchase for them, and they saw in that case, because it was a controlled business, they could just see the way it mushroomed, and and so I think that if you get into businesses where management is exceptional, or the moats are exceptional, or in the case of Google, you get both. Buy one get one free, which is great. Then I think those are businesses you just don't want to touch. I met some folks in India in some of these meetings that blew me away. I mean, in some cases, I just looked at it and said, this is there's tailwinds, but in addition to tailwind, there's a phenomenal operator, and the price was below liquidation value, and so those are all good tenants. So that's what we want to look for is, but clearly, in my opinion, I don't buy the notion that you buy your portfolio every day. To me, buy and hold are different. And the cheapskate in me still wants to not pay up. But I was able to, at a point in time, get to where Google was just at the edge of making it, so it made it, which is great. And that's the key: is that you want to ride the compounders for long periods.
100-bagger stocks exist in hundreds, but very few investors ever catch one. And the real tragedy, most people sell them after a quick 50% or 100% gain, long before the real compounding begins. If you ever get your hands on a potential 100-bagger, you hold it tight. And today I will show you a simple but powerful framework from a legendary Indian investor, Vijay Kedia, that helps you spot these rare winners early. It's called the SMILE concept, and once you understand it, you'll never look at the small caps the same way. So Vijay Kedia's SMILE investing concept goes like this. S stands for small in size. Look for small or emerging businesses. Every giant multibagger started as a tiny company few people cared about. M stands for medium in experience. Prefer companies that have survived 10 to 12 years. They have seen cycles, made mistakes and learned, but still have room to grow. I stands for large in aspiration. The management should dream big. If leaders don't think beyond today, the company won't grow tomorrow. L stands for large in market potential. The industry must have a long runway, 10 to 15 years of demand, growth and opportunity. E stands for extra large in execution. Execution is a real moat. Ideas can be copied, but consistent execution can turn a small business into a 100-bagger. And here's the entire concept in one powerful line. Invest in companies that are small in size, medium in experience, large in aspiration, large in market potential, and extra large in execution. When a stock ticks every box of smile, you don't sell it. You sit tight and let it compound.